Hey man, you retired early, right? Yes, and I'm so glad that I did. So how do you deal with all the early withdrawal penalties? Isn't it like 10%? Actually, I don't pay a penny of early withdrawal penalties or federal income tax. Wait, what? Is that legal? You're not afraid that the IRS is just gonna, bust into your house with guns blazing? It's perfectly legal, my friend. Thanks to the Roth IRA conversion ladder. Hello everyone, my name is Zach and welcome to On Cashflow, where I help you become a master of your own cash flow. Now let's get started. Let me give you a quick recap on the Roth IRA ladder strategy. Basically, it's a long-term method of minimizing your federal income taxes. It works best if you're making above the median income or higher, where you're in a higher tax bracket, usually the 22% or above. This method not only avoids the early withdrawal penalty in early retirement before age 59 and a half, but it also avoids those higher income tax brackets of the 22%, the 24%, and so on. And basically, there is only 4 steps. Step 1 is to earn the big boy bucks. Step 2 is to contribute to traditional accounts and significantly reduce your taxable income while you're earning those big boy bucks. Step 3 is to retire early. And step 4 is to slowly convert your traditional accounts into a Roth IRA over time. It is a big part of how I am able to be retired early. I think that the Roth IRA ladder strategy is one of the best ways to retire early for the vast majority of people out there who are interested in financial independence and early retirement. I think so highly of this method for retiring early that I even wrote a book on it, but more on that later. I want to give you a quick case study on how the Roth IRA conversion ladder can save you thousands of dollars on your taxes, not only while you're working, but while you are retired as well. For this example, let's use a hypothetical couple here. We'll call them Jack and Diane. Jack and Diane are married filing jointly, and they make a healthy amount of income. Both of them make about $80,000 per year before taxes. So combined, they make about $160,000. This puts them in the 22% marginal tax bracket. They get to take the standard deduction, which is currently $27,700. You subtract that from the $160,000, and that means their taxable income before any kind of adjustments is $132,300. And that fits them right there in that 22% marginal tax bracket. Jack and Diane plan on using the Roth IRA conversion ladder, and therefore they are maxing out their traditional 401ks at work. They are able to put $22,500 each into their 401ks, or a combined $45,000 per year. They can go ahead and adjust their income downwards by $45,000. So their taxable income before was going to be $132,300, but we subtract $45,000 from that for their contributions, and that leaves them with $87,300 of taxable income. Now, according to the federal tax brackets, they are in the 12% marginal tax bracket instead of the 22% bracket. That $45,000 that they put into their traditional account is going to save them thousands of dollars on their income taxes. That's because most of that was going to be taxed at 22% and some of it at 12%. Now I went ahead and did the math on how much taxes they would save, and that number is $9,685 of taxes saved. So they saved nearly $10,000 of taxes just because they planned on using the Roth IRA conversion ladder. And keep in mind, they could put even more money away if they wanted to. They could put money into a HSA if they have the appropriate high deductible health plan. They could put money into their traditional IRAs to save even more and reduce their taxes even further. And then when they actually do retire and they no longer have a high amount of income from working, they can slowly convert their money and pay a low amount of income taxes on that amount as well. Now, if you're appreciating this video so far, I would really appreciate it if you hit the like button on this video. It really does help me out, and seriously, I really do appreciate that. But getting back to it, I want to discuss some really important points when it comes to using the Roth IRA ladder. The first one that I want to discuss is the ordering rules for distributions, because this is a little part in the IRS code that makes all of this possible for you to retire before 59 and a half using this method. And basically what the ordering rules are is what is counted first when you're withdrawing money from a Roth IRA. The first thing that's counted is the contributions that you made to the Roth IRA. So this is direct contributions. So if you have a Roth IRA and you convert, let's say $5,000 per year for 10 years, then you would have contributed $50,000 to that Roth IRA. So when you withdraw money from a Roth IRA, that $50,000 of regular contributions is what is counted first as what you withdrew from that Roth IRA. Secondly, what's counted is the conversions or rollovers. In this case, if you're using the Roth IRA conversion ladder, you are doing conversions. And so any amount that you convert is then counted second after your initial contributions. And then third and last is the earnings within the Roth IRA. So hopefully if you have money in a Roth IRA, you have that money invested, and any kind of earnings that you make, that is going to be counted last after you've exhausted your contributions and after you've exhausted any kind of conversions or rollovers that you made into the Roth IRA. Knowing those ordering rules is important because this ties into what is your Roth IRA basis. Your Roth IRA basis is basically how much you contributed to that Roth IRA versus how much of it is earnings. So you might have $100,000 currently in your Roth IRA, but you want to know how much did you contribute, how much did you convert, versus how much has the Roth IRA earned over the years. In order to find out what your Roth IRA basis is, you take your total contributions minus your total distributions. So how much money did you put in versus how much money did you take out? In order to figure out how much money you put in, you need to add up all the contributions that you directly made to your Roth IRA. And usually you'll be able to find this on Form 5498, which is usually issued by your investment broker every year that you contribute to an IRA. So if you did contribute to a Roth IRA directly over the years, $5,000 for 10 years, then you would have a direct contribution of $50,000. And if you also made a $50,000 conversion to that Roth IRA, let's say it's year one of your early retirement, then you would have the $50,000 plus the $50,000, which is $100,000. But there is one more thing you need to keep in mind before you count that conversion. And that is that the conversions have a 5-year waiting period before you can withdraw them tax and penalty free. So that means if you do retire early, you're going to have to somehow make it for 5 years before you can take your first conversion. Let me go ahead and put up a chart that I made because it makes much more sense when you're able to look at these kind of charts. So you can see the conversion that you made in year one, or you can say it's year zero. You were able to withdraw that conversion 5 years later, tax and penalty free, before age 59 and a half. Now this leads me to the big question here. I want to know from you in the comments below. Do you plan on using the Roth IRA ladder in your retirement, in your early retirement? Do you plan on using it as part of your strategy? Why or why not? I'm really curious to hear what you have to say. Please let me know in the comments below. But there is one more thing that I do want to note here, and that is tax diversification. Tax diversification is basically having your money in different kinds of accounts that get taxed in different ways. So perhaps not having all of your money in a Roth IRA, perhaps not having all of your money in a traditional account, perhaps not having all of your money in a taxable account, but instead having some money in each of these kinds of accounts. And that's because the Roth IRA ladder strategy, while it can be a major part of your plan to retire early or your plan to retire, it doesn't have to be the only strategy that you use. It can be a primary part, it can be a smaller option. It's not an all or nothing thing. Nor is the Roth IRA ladder the best strategy for everyone. It usually works best if you're already going to be in a high income tax bracket. If you happen to already be in a low tax bracket, if you happen to only be paying 10 or 12% of marginal taxes on your income, then maybe it makes more sense to just directly contribute to a Roth IRA, directly contribute to a Roth 401k, put more money into your taxable account, or whatever it may be. Now, I want to say that I did not explain in detail, like step by step, how the Roth IRA ladder works in this video for several reasons. First off, I have made videos in the past that explain in much more detail step by step on how you would make the Roth IRA conversion ladder work. Plus, I just revamped my book that I wrote on the Roth IRA conversion ladder strategy, and I want to share that with you right now. I'm going to put a link to the book in the pinned comment below, and I would really appreciate that if you click that link and if you just checked out the book. Even if you're not interested in buying the book, it's very low cost, but even if you're not interested in buying, if you just click through that link and just checked it out, I would really appreciate that. And if you want to watch those videos that I made on the Roth IRA conversion ladder step by step on how to make it happen, that is going to pop up on the screen right after I get off the screen. Thank you so much for watching this video. I'm Zach from OnCashFlow.com, and I hope to see you next time. One of the most important ways Did you get her?